Hello everyone. Sorry I've been a bit late, 5 minutes late apparently. So I'm here. Welcome. It's Bollinger's. I know it's very well known. It's a very well known indicator, but we're sorry, we're gonna just take a different approach this time. I will quickly go through the basics of what is a Bollinger Band, what does it show, how we can read it, and etc. But today's webinar is about a bit more advanced, slightly more advanced. So it's how we could use double Bollingers or even triple sometimes in order to limitate even more our risk, but also to be able to add on our positions. Okay, so some of the benefits of having double or triple Bollinger Bands is that. Okay, so before I start, I need to go through the admin as usual. On the handout section, you will soon see the PDF version of today's webinar. So you can all download it. I think it's at 100%. So just upload it. So it's there for you. You can download it. I remind you that this webinar is being recorded as usual. So later on or the latest tomorrow, you're gonna receive an email from our team with the recording. If you're in a hurry and you want to see it, I don't know, tonight maybe, please subscribe to our YouTube channel, and as soon as the webinar is uploaded in YouTube, has been uploaded in YouTube, you will get a notification and you can see it, you can watch it on spot. So let me go through the disclaimer warning as usual. Please, in the meantime, I would like confirmation for at least one of you in regards to the audio, where you can hear me loud and clear, you can see my screen and etc. as usual, okay? Just to make sure that I'm not speaking all alone. And you're here and you can actually hear me. So this material is provided as general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the user is solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved. Take into account your investment objectives and level of experience before trading. And if it's necessary, seek independent advice. Please read the full risk disclosure in our website along with all the legal documentation that you might want to check. So admin now is out of the way. Thank you guys for confirming. Thank you, Christopher. Thank you, Excellence, Fidelis, Sewa. I don't know. Well, you have a really, really long name there. So, okay, we can start. As I will repeat myself once again because I have seen that there are people that they have just joined. You can find the handouts in the handout section, the PDF version of this webinar. So feel free to download it. So this is the email address, sorry, webinars@hfm.com. So feel free to ask anything you want. Text me, I will reply, or Stuart. Unless if it's something that is not, it doesn't have to do with analysis, and support team will reply on spot. So this is our email address. You can ask anything you want, not necessarily only about webinars. It might be about fundamental analysis, technical analysis, a strategy that you're struggling with, and etc. Okay, so that's me completing my 5th year. Actually, I'm already in the 6th year. Yeah, maybe I'm already in the 6th year of in HFM. Previously Hot Forex, we shifted into HFM, but we are the same people, just rebranded, evolving to HFM, since we have introduced physical stocks as well. So we have launched investing accounts. So we have diversified ourselves. With us, you cannot you can trade CFDs, but you can also invest in physical stocks. So that's why we had to change the name from Hot Forex to HFM, because we now, from now onwards, we also offer offer you the chance to invest, not trade, invest in stocks as well. So invest or trade. This is upon your decision. Okay, so shall we? Trading with double Bollingers. So what we're gonna cover today is, okay, I'm gonna very briefly, I will try very briefly to go through some of the background of Bollingers, what they are, what they show, and etc., the single ones. Then I'm gonna introduce you what we mean by saying double Bollingers, and actually today's main topic will be how you can apply a double Bollinger Band strategy, and more precisely, double Bollinger Band strategy from Kathleen Lin. So it's a strategy from here using double Bollinger Bands. So there are some rules. We're gonna go through them, and also we're gonna go through any limitations, pros or cons that we're getting from applying double Bollingers. So how you can read double Bollingers, what signals they provide you, when is a good time to join, to open a position based on what you have identified from Bollinger Bands, whether and how and what time you should join a new trend by observing Bollingers, and so on and so forth. Okay, so 28 slides it is. So, but the first few are on the basics of Bollingers. So I'm gonna, oops, I left, that shouldn't be here. That's okay. Ignore the first slide. Sorry, that was from a different webinar. Sorry, I will delete it. So ignore it. That's my very first slide. It's a bit of a brief introduction on Bollingers. Yes, okay, I have deleted it. Perfect. So hopefully I haven't done other mistakes like that. Bollingers, as per the name, it has taken his name from this particular man, a brilliant man, John Bollinger, the creator, the developer of Bollinger Bands in the mid of 1980s. That's why he trademarked it, is after his name. Bollinger Bands is a technical analysis tool, and more precisely, an oscillator. So it's an indicator which we can see being applied on the chart, not below the chart, on the chart, and it can be used for identifying market volatility over time for any type of instrument. Okay, it's for any type of instrument, but it might need some adjustments based on which time frame you are trading or which asset you are trading. But it can be applied in everything. You might just need to change a bit the settings in order to apply it properly. So this is a creator. It's a very popular technique, very popular methodical tool, simply because it helps us to take any trading decisions, to control our systems, our trading strategies, and it can also be used as oscillator or just as a technical tool for identifying a trend, identifying volatility as well. This is how it looks like. So it consisted by 3 lines. I will say that very, very briefly because the people that attended last week's webinar, they have seen that. So consistent by 3 lines. The middle line is a 20-period moving average, and the other two, the upper and the lower one, are standard deviations of our simple moving average. So if you apply your Bollingers on a daily chart, what you will see is a 20-day moving average and a standard deviation above or and below your moving average. Okay. So it's a plus standard deviation that brings us shows us the upper line, and a subtraction from the moving average gives us the lower standard deviation. Why is so important to have also why these the 2 lines, the lower and the top and the lower one, why they are so important? Simply because we can use them as a measurements of volatility. The wider they get, the more the volatile the asset is. Because the good thing about Bollingers is that they give us a price range. So because they are calculated based on the price of the asset, and more precisely the average price of the asset, and also they give us the positive and a negative range of the price action. You see, it's the price should always be contained within Bollinger's Band range. If it's not contained within the Bollingers, it means that you need to change your settings in order the price to move to be contained within this statistical tool, within the Bollinger Band range. What I mean by that, if you apply it, okay, let's assume that you are, I don't know, you're a 5-minute trader, okay, or wait daily, whatever kind of trader you are. If you apply your Bollingers, okay, and let me just quickly, and you see that the most of the time the price is outside the Bollingers, that means that this is not the appropriate setting for your Bollinger Band, because the Bollinger Band is a price range. Okay, it's a range in which the price is moving within. Okay, so that is not helpful at all. So regardless of which time frame you are, regardless of which asset you're trading, you need to make sure that you have applied a Bollinger in which the settings satisfy the particular asset, and we can see that it provides, you see, that the price is moving within the range. It doesn't mean that sometimes you will not see it closing outside, but the most of the price movement should be within the Bollingers. What you should do most of the time is first trying the default setting, which is the one that I'm using, okay, 20 to 2. So if you drag and drop your Bollinger, that should be the default settings. And if the default settings don't like fit, you can amend it. Now let's move on back to our slides. So the upper line, it presents a relative strength. Both lines actually, both upper or lower line, they give us some signs in regards to the strength of the trend and whether the asset is ready to reverse. Okay, whether we're gonna see some kind of a turn. Also, how wide or narrow the lines are, that this is where we could figure out the volatility. Okay, here we are. So it's a very, very highly popular technique, obviously. But I mean, each one of us and each one of you guys, each one of the institutional players, etc., they use it with a different way. Many traders believe that the closer the price moves to the upper band, the move is overbought. Or the closer the price moves to the lower band, the move is oversold. There are many, many ways to use and to amend and to adjust accordingly the Bollinger Bands. That's upon each one of you, the approach that you're having in the market, what kind of trader you are, scalper or not, and etc. But yeah, today we're gonna focus on a particular technique, more precisely the double Bollinger Band technique. Okay. So just over here, I have some pros and cons just for you to have in mind. It's an indicator, it's an oscillator, so it derives its price from the it derives its number, it derives its results from the price, right? So it takes the history, like every single indicator, it takes the historical prices and it presents where the price is based on the recent history. Presents volatility, again, based on the history. That's why it's an oscillator. It gives signs of high risk. So if we observe Bollingers and we get a sign of very, very high or even extreme volatility, that means high risk as well. They help us identify also direction and the market momentum or otherwise energy. They're very easy to understand and straightforward, but they have some disadvantages as well. Nothing is perfect, right? So what you should really take care in regards to the Bollingers is that they can for sure provide some signals, buying or selling, but they cannot provide absolute buy and sell signals. Okay, so that's why in this that's why it's good to be combined with something else. In today's webinar, we're gonna combine it within self. So we're gonna use two double Bollinger Bands in order to limitate any false signals. You can combine it with other indicators such as, I don't know, RSI, stochastics, moving average crossovers. That's up to you, and that's how that this is based on what kind of setup you're using in your daily trading. Also, the other negative thing about Bollingers is that they work on a trending market and not ranging market. They can provide support and resistance level, so in a ranging market, but it's preferable not to be used for any buying or selling signal if the market is ranging. Last but not least, as I said, needs to be combined with other indicators in order to limit any risk, okay, of false or non-accurate signals. Now, so for sure, the single the single Bollinger Band is the most popular indicator. But double Bollinger Bands are arguably the single most useful technical indicator. So double Bollinger Bands, so in a single chart to have two different types of Bollinger Bands, are among it's not something that you can, I cannot really say that it's very popular, but it's a strategy that that is very, very useful. And if you're a fan of Bollingers, then you should try it, okay? So at least in a demo account first. Why? Why consider to be a very useful technical strategy and maybe among the first indicators that one should check. Why? So the reason for that is because they're telling us the fact that we're using double Bollingers, so two Bollingers but with different settings in a single chart. This is what we mean, double Bollingers. So they look like come on, let me just go. They look like that. Okay, so I have two double Bollingers, one with a standard deviation at 2, which is my default setting, and one with a standard deviation equal with 1. Okay, so but until we explain how you can read this type of how you can apply this kind of strategy, let me go through quickly. Oops. Why? What they can tell us, how the double Bollinger can help us. First, as I said, and I'm showing over here, in general Bollingers, either single or double, they show us trend. Okay, they help us to identify trend. So when a trend, however, is strong enough to continue riding or to or to consider entering new position, even if the trend has been going on for a long time, even if it had reached historical highs or historical lows, the Bollingers will give you, the double Bollinger will help you identify entry points, even in these cases, even in the cases that the trend is strong, it's been going on forever. I don't know, it lasted for months. You were thinking maybe it's time to reverse or not, even if it has reached historical highs. So the double Bollinger will help you to identify near support and resistance levels in order to add more position on the existing trend. Okay, so or in other cases in which we don't have a strong trend, but instead we have a trend that is not so clear. When I mean there is no clear trend and you need to either stand aside or switch from trend following system to a range trading system. The double Bollingers, even in this case, will help you to open some short-term positions, or they will help you, they will signal you when it's time to take profit or to get ready to trade the reversal. Okay, so this is the benefits of having a double Bollinger. We're going to see the benefits in a while anyway, again. The next two slides are just it's again explanations on Bollinger Bands, single or double or etc. I mentioned standard deviation. So for those that they might don't know what is a standard deviation, okay, in general mathematics and statistics, okay, the standard deviation is a measure that is used to quantify the amount of variations of a set of a data values. Okay, I will simplify that. I know that it sounds like nonsense. Okay, so we have data, right? For every single indicator, it's taking the historical prices, and through a formula, it gives us some results. The same happens with the Bollingers. So the standard deviation, okay, it's, how can I say that? How can I simplify what is a standard deviation? Is the measure that we use to see any dispersions of the prices. So, for example, low standard deviation shows us that the data, that the prices tend to be close to the mean, to the average price. While the high standard deviation shows us that the prices are spread out over a wide range of values. You don't need to know this stuff, guys. Okay, I'm just trying to make you understand what the standard deviation is in order to comprehend better what these lines, the upper and lower one, are. So as I said, in Bollingers, we have this middle line. This middle line, the gray one, is the 20-period moving average. So here is a euro pound 1 hour chart. So this gray line is our 20 hours moving average. So the moving average of our euro pound for the previous 20 hours. So using a formula, okay, which we won't use. I mean, something that is done automatically. The Bollinger Band indicator adds 2 standard deviations on this 20-period moving average. So that's how this line is drawn. The upper line is drawn, and subtracts from the 20-day period moving average. Yeah, subtracts and give us the lower line. So so we have an average value, right? So think about that. We have an average value, which is something like that. So the calculation of standard deviation is done with this way. So deducting a particular percentage from the average. So it gives us some results that are plotted at the top. And if we subtract the particular number, the same number from the moving average, it will give us the lower line. So it's like like the moving average, we have the absolute value, but at the left and the right, I mean above and the below, we have the bands in which are actually a particular some particular lines in which we have abstracted or added to the moving average. So okay, I know that's a bit more complicated. You don't need to know that. You don't need to understand. What I want you to understand for sure is that with Bollinger, we have 3 lines, a middle one, and one on the top, one on the bottom, with the same distance away from the moving average. And it gives us the price range. So the price needs to be within this range. This is what I want you to keep in mind. The wider the Bollinger Bands are, what I mean by wider, the far away they are from the middle line, that implies to very high volatility. The tighter they are, like here, you see how close to each other they are, the lower the volatility. Okay? So, Here it is. This is explanation again. The wider the Bollinger Bands are, you see over here, they're very far away from the middle line. So it means high volatility, which you know in trading is not necessarily bad. But it could cause some sharp rises or declines. That's why you always need to take care of your risk management. But the low volatility, so situations like that implies to very low volatility. The narrow Bollinger sorry implies to low volatility, so we might see really small, dodgy, choppy price movements, or even the market to enter a ranging market. And in general, regardless of the double Bollinger, if the price has breached the upper line of the band, okay, that suggests two things. That either if it's in an uptrend, it will continue its uptrend, so implies to further positive strength, further positive bias, further bullish bias, or it might mean a reversal back to the middle of the range. So it might be a selling opportunity. Or in the case that it breached the lower line, again, this might means two things. Either that it has been oversold, so it might reverse to the upside, so that could be a buying signal, or if it's in a downtrend and extends further to the downside, touching again and again its lower line, it might be a selling signal. So you see, like here, rebounded, so one candle up, one candle up again, touch the upper Bollinger, and the very next one touch a broken the upper Bollinger. Okay, so showing that two things. Over here, we could say, okay, something is wrong. It's overbought, so it might reverse. But the next candle, if I zoom in, the next candle closed very, very weak, small body candle, and remained outside Bollingers. So that was an indication that there weren't enough sellers to turn the price back down, like here, okay? So what happened? So there was a question mark here. We couldn't really tell whether it's ready to reverse or whether it will extend further to the upside. So the next candle came with another bullish candle, again outside Bollingers, confirming that this is a continuation of the uptrend signal. So that's a buying signal. So apparently there was a really strong uptrend over here. But in some cases, we might see reversal. So we need to be patient enough to wait for confirmation in order to find out whether we have a continuation of the move scenario or a reversal of the move scenario. Okay? Because if it just touches the upper or the lower Bollinger Band, it doesn't really mean anything. It means something if we got the confirmation whether it will be a continuation of the trend or a reversal. So that's why we need to wait for the next candle. So for example, over here, we could see it touching again and again, okay, the lower line. So we're like, okay, what's going on over here? It was already in a downtrend, but is it like gonna extend further lower? The Bollinger started to flat a bit, not to extend lower like here. They started to find some kind of a support over here. So the signal that a reversal, a strong reversal might be seen came initially with these two candles, which they quickly revert back down again, but not posting a new low, but instead posting a double bottom over here. but the certainty came with these two bullish candles because the body of those were really, really big ones and strong enough, and extending and posting a new high that broke in the previous ones. So it's not only about observing whether the price has breached any of these lines, it's also to read your candles. That's why it's an indicator that it needs to be combined with other stuff. So if you are interested, if we have any newbie over here that has never used Bollingers, doesn't know them, it's the very first time that he's seen them, it's better, guys, to go back to my past webinars and check mine and Stuart's webinars about Bollinger Bands. So we have webinars that are exclusively for beginners, okay, with many, many examples on how you can read your Bollingers. But today it's a bit more advanced one, so I cannot really spend more time on the basics. So finally, we got to the strategy, to Miss Kathleen Lee's strategy on how you can apply a double Bollinger and what signals it can give you. So what we have over here, double Bollingers, according to Kathleen Lee's strategy, you can use either in the MT4, either in the MT5, that's not an issue. You need to apply two Bollingers, okay? One, the default one, which is 20 period one and 2 standard deviation, and another one, again, 20 period one, but with 1 standard deviation. So what you're gonna do is open your chart, okay? Let me remove everything. So the very first Bollinger that you're gonna add will be the default one, so 20 and 2. You see, period 20, deviation 2, okay. And then you're gonna add again another one. Better to change the color. You're gonna change the deviation into 1. Okay, so are you seeing that we're getting, so with this way we have added two Bollinger Bands, but with different standard deviations. So with this way, we have created 5 lines, right? So we have in the middle, the 20 period, moving average. This is the daily chart, pound daily chart, cable daily chart. So in the middle is a 20-day moving average. And with a green line, we have another 2 lines. We have with the other 2 green lines are 1 standard deviation, plus 1 standard deviation, and minus 1 standard deviation. And the other 2 lines is our plus 2 standard deviation and minus 2 standard deviation. So we have 5 lines. If you notice carefully, that creates 1, 2, 3, 4 zones. Okay, 4 zones. So what else I wanted to add in this? Yeah, okay, let's move on. Let's move on. Okay, what these lines and these zones present to us, how they help us. Actually, let me check. I'm gonna add a chart over here just to help you. So, okay, okay. Give me a second, sorry. Gonna add a chart just to help you see it while we are talking. So, okay, it's not the gray, this is a small one. Okay, let's leave it here. So, okay, we have 5 lines. So, we have 5 lines. So, let's call it Okay. So we have 5 lines, and over here I'm saying 3 zones. Why? I'm excluding the neutral zone. If I include the neutral zone, then it would be 4 zones. If you count 1 zone, 2 zones, 3 zones, 4 zones. But excluding the neutral one, we have another 3. So what I mean, the first zone is the zone between the upper 1 standard deviation line and the below 2 standard deviation line. So is this area, okay, this one. I think I'm gonna bring the big chart on, okay? So, and I will put numbers on as well, or numbers. Okay, let's do it with, so this is the very first zone, okay? It's above the first standard deviation and below the upper second standard deviation. Let's call it 1. The next zone is below the lower standard deviation, but above the lower 2 standard deviations. So it's this area over here. Okay. Okay. So have in mind that in this area over here is an area in which we might see long positions. This area over here is an area in which we might see short positions. Okay. So the price remains, if the price, okay, I'm going to rephrase it because it sounds a bit wrong. So if we are in a downtrend, okay, with the price extending over here like that, extending and insisting and moving within these 2 lines, within this area, and posting lows in this area, then that means there is a lot of bearish buyers, a lot of selling pressure. So we might add more short positions into that. Okay. If our asset is in an uptrend with the price persistent to stay in this zone, posting higher highs, that's where you can add more additional, if you prefer, long positions. Now, we have more areas, right? So another area, another zone is the area under the upper 1 standard deviation line, so below it, but above the lower standard deviation, the 1 standard deviation. So this area, okay, this area. So zone number 1, zone number 2, zone number 3. Is that clear? Okay. Okay. Okay, so this is our neutral zone. This is a zone, a big zone in which we can either add more positions or closing some existing positions, trending positions, or look for oscillating trades. Okay, so we're gonna see examples so you can understand what we mean. So here are the rules that, and here is how you can trade double Bollingers based on Miss Kathleen Lean's strategy and her rules. So according to this strategy, if we need to wait to see a break of the price into the neutral zone. Remember, I mentioned that we call neutral zone. Come on, we call neutral zone. Come on. this area, okay? This area between the upper and lower one standard deviation. Okay, this one. This is called the neutral zone. So based on Kathy-Lee strategy, the very first thing that you need to confirm is whether the price broken and enter the neutral zone. So it has entered the neutral zone here, 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 right here, it entered back to the neutral zone. Okay, here as well, but it quickly left it out. So every time that it enters and closes the candle within the neutral zone is the very first sign that we have a break of the neutral zone. So now we should take decisions. If we have seen something like that, we need to wait the next candle in order to find out whether we're going to enter long or short or not enter at all. So for taking a long position, it means that the price entered the neutral zone, okay, and closes within the neutral zone, okay? So if something like that happened, that's a long position. So if our price broken and closes above the lower one standard deviation, that's a sign for a buying position. In this case, okay, so let me get back to my chart because it's a bigger one, so we can zoom in a bit and check. So let's take this, for example, okay? This, for example. It breached it and closed within the neutral zone. So it is where we can trigger a long position. So what kind of stop loss we should use in this case? We can place our stop loss 2 candles below our entry. So if this has been our buying entry, because we need to wait for this candle to close before we take our position, then we could use this as our stop loss. So to go to stop 2 candles below, 2 candles to take the 2 previous candles. So we can add our stop loss here. The target level, the very first target level, should be placed at the 50% of the position. So since we have placed our stop loss here, the very first target, so here the distance is okay, 166, so that means divided by 2, that should be 83 pips, so that means our entry should be somewhere, let's measure 83, somewhere here, okay? So 50% of the position. That's the very first target, okay? So then the second target, if you want to use multi-targets, by the way, so that's the very first. So if the asset breach this level, so the 50% of the position, you can close the 50% of your position, okay? So if it breached that level, okay, we can close the 50% of our position and we can shift our stop loss. We can shift our stop loss on the entry point, okay? Then, in regards to the remaining 50% of the position, it could be twice we could close, we could have as our second target for the remaining 50% of the position twice our initial stop loss. So our initial stop loss was 160 pips below the entry level, right? So 160 pips multiplied by 2, it means 332 pips away. So that means it should be somewhere here, 30, 31, 331, 331, 332, somewhere here. So for the remaining 50% of the position, we drag and drop our stop loss into the entry level. I will get rid of the target one because it was already breached very, very quickly. And the remaining of the position will close as soon as the target hits twice the initial stop loss. Is this clear? This is a long trade. Do I have any replies? No, yes. Okay, you can tell me, Andrea, you have a wrong signal over here. That was a misleading signal, right? Please explain it again on the profit target. Don't worry about it because I write everything over here. So in this example, I was ready to complicate stuff, Christopher, I was ready. Okay, you are okay with the stop loss, right? We place our stop loss 2 candles below, fair enough. We took the entry over here, right? So you can, okay, that's Kathleen Lee's strategy. According to the Kathleen Lee strategy, your first target should be a close one, and the second one should be twice the stop loss. So let's measure, because I think I've done a mistake as well. Sorry for that. So let's measure. So entry, stop loss, and let's measure it. Okay, here we are. Oh, sorry guys, that I know I confused you because I did a mistake. I placed the first target too tight. So, okay, I will do it again. Sorry, my bad. So, I'm measuring the distance of the entry from the stop loss, okay? And it's around 166, it was before, yeah, 166 pips away, okay? So, target number 1 should be equal to that, 166. Yes, I did a mistake earlier. I put it, okay, here is, so this is our first target. So somewhere here should be our first target. Another 160 pips. So the same distance, the same distance that the entry has from the stop loss. So the first target should be the same distance from the entry level. So you see that they are equal, the distance is equal. So target number 1 should be that one. As soon as the target, as the price touches your first target, you can close the 50% of your position, okay? And once you do that, you can drag and drop. Actually, you can, if you drag and drop, it means that you have locked the 50% of your position, okay? So this is the way. Once you don't need to add a target. So let's say you're buying. Come on, I'm in a demo account, right? Trading, new trade, open, new order. Come on. Oh, here it is. So you see, over here, you will add only stop loss. You won't add target, okay? Take profit, okay? Or if you want to add take profit, you need to add the second target, not the first, okay? So the second target should be double the distance from the entry. So 166 pips multiplied by 2 is 332. So that means 332. So my second target should be over here, somewhere here. Okay, so over here you can add your second target, and here the stop loss, as we said, over here, down here, 2 candles below. Now, as soon as the asset breach the 166 pips, so as soon as it breach the distance, the same distance that our stop loss had from the entry, so this distance was 166 pips. As long as it moves 106 pips up higher, we can drag and drop our stop loss higher and place it on the entry level. With this way, we are locking the 50% of our position. We're closing the 50% of our position. We are locking the 50% of our profits. And then the other 50% of the position will remain open until it breaches our second target. Is that clear now, Christopher? I'll wait for your reply. Yes, okay. Like every other indicator, it cannot always be right, okay? And you see in this case over here, in which it broken the neutral zone and it closed above it. That supposedly should be a long position, but it quickly, with the next candle, it quickly turned further down. Nothing can be 100% accurate. That's why in order to avoid this kind of misleading situations, okay, you need to combine it with another indicator. That's upon your preference, okay? It might be MACD, it might be something else, RSI, and etc. So if I use my MACD over here, where's my MACD? Here it is. Let's see. Okay, you see, very interesting. Very, very interesting. Instead of showing some kind of a detection of the selling pressure, it shows further decline. So I could had avoid to enter because I didn't had any positive signal. You see that? Okay. So RSI still down. Sorry, RSI and MACD still down. RSI peaked a bit, but turned down again. So that was an indication that is not recovering. While over here, I had something completely different. RSI crossed 20 and it was pointing further to the upside. So over here, it topped again. And at the same time over here, my MACD histogram lines were above the signal line. So that means that the sellers are losing control. That's what needs to be combined, just to confirm that your decision is a good one. Okay? So again, you see another misleading signal was this one. It entered, but here, the only thing that we could see is further selling pressure, right? So it's good to be combined just to confirm your decision. But anyway, if you place your stop loss, you're limiting your risk with this way. Now, for a short position, it's the same thing, vice versa. So let's check together. For a short position, let me clear a bit this mess, clear these lines. Based on Kathleen Lean's strategy, if the asset breaks the higher 1 standard deviation and closes below it. So like what happened, let me go backwards, like what happened here. Here, it was above and it closed, it enters and closed below the upper 1 standard deviation. So here, if something like that happens, okay, you can enter short. Let's see what's going on over here. So that is not so clear. Mine wasn't a confirmed break. So it was the very first sign, but over here we have some mixed situation because RSI is at 51. MACD is still showing some positive bias, so I should have probably ignored this signal. But let me see something. Okay, no, yeah, it was a bit of a weak signal. So let's go backwards to find another one. Okay, up, doji, turn down until it broke it. So here we are, close below it. RSI started to clash with his histogram, but RSI is the one that gave us the confirmation because it reverted from the highs and started turning lower. So that was a nice entry point, this one, or the next candle over here. So here at the open price, that was a nice a short entry with stop loss. Remember, two candles above. So 2 candles above means 1, 2. That means here. So stop loss should be here. Okay, 2 candles above. So let's measure this distance. This is the entry, and this is around 111 pips. So target number 2 will be 112 multiplied by 2. That's 222. Let's measure it. 2 and 2 should be, oops, 2. Come on, 2. It should be somewhere here. 2. Okay, let me be precise. 2. So 135.8, 1.358 minus 222 pips. That takes us to 1.136. Oh, sorry, 1. Let me do it again. Okay, 135.8 is our entry point minus 13358. 13358. Ooh, oh my God. Oof. Okay, that's very precise. Oh my God. Okay. It wasn't on purpose. Okay, it wasn't on purpose for sure, but it would have been a very successful trade just before the reversal. That's excellent. So what we're doing, that's target number 2. Okay, stop loss over here. So target number 1 should be at, let me do the calculation, 135.8 minus 0.111 equals with 134.69. 134.69, somewhere here. Okay, I cannot put it precisely, but target 1 should be this one. So as soon as our price touch this level, we can drag and drop our stop loss at the entry point. So with this way, we are locking 50% of our position, our profits. And the other 50% will be closed as soon as the price breach the target number 2. Okay, so what you're doing, simply selling. Stop loss, it was at, let me find it again because I forget where the stop loss is. It was at 136.91.8. Target number 2 was 133.58, and click sell. But you need to have an alert on target number 1, or to have a second position at 134.69, which is our first target. Yeah, so this is how you should open a short position based on this strategy. Please, what you need to ignore, what you need to be careful about. If, remember that we said that in a case in which, let me find something like that. I don't know whether I will be able to find something like that. There are cases in which if you see a candle, okay, I cannot find one right now. If you see a candle that from being at the top breaks the first standard deviation and breaks the how we call it, okay, let me find an example if it's that easy or not. If there is a candle managed to enters the neutral zone, but it's so big that it managed to enter the neutral zone at the same time closing above the 20 period moving average, that suggests extreme or very big volatility. So you shouldn't, that's an extreme move, so you shouldn't take any decision if something like that happened. I cannot really find an example like that, I think, right now, but let me see. What I mean is a single candle to break the first standard deviation and to break and to close above the 20-day period moving average as well. So like okay, I cannot find one right now, guys, but it is when you have a lot of volatility. So if, for example, this candle broken the standard deviation and it was closed up here, that's extreme volatility, so you shouldn't take the trade, okay? So I'm pretty much done. I need to go because I have a live analysis right now, so I need to run because I'm gonna do a live analysis in Facebook and YouTube right now, so you can join me. So the next candle, we covered everything. It's just the next candles are everything that we have said today in details. So I have again separated the zones over here, explaining what each zone is, okay? Which zone is a buying zone, which zone is a neutral zone, which is a sell zone. We already mentioned that. It's just you're gonna find them in slides as well. We have showed the rules of Kathleen Lynn's double Bollingers. So it's an explanation over here. So again, here is how to open a position. We have already seen that. The only thing that we haven't seen and we don't have the time to cover it right now is how to put additional position on your existing position. So please have a look at it. And if you're struggling with it, please send me an email at webinars@hfm.com. Okay. So I'm gonna call it a day because unfortunately I need to run. Please read the rest of the slides and let me know for anything that you don't understand. What you should, if I need to summarize a bit the webinar today, is that using double Bollingers will help you to decide when you should be trading a trend or trading a range or refraining from a trading. And I will finish with Kathleen Leon's words. She mentioned that of the hundreds of technical indicators out there, the double Bollinger Bands are hands down my favorite. They provide a wealth of actionable information. They tell me whether a currency pair is in a trend or a range, the direction of the trend, and when the trend has exhausted. More importantly, Bollinger Bands also identify entry points and proper places to put a stop loss. Okay, sorry, I need to call it a date. I have 5 minutes until I'm ready for a live analysis in Facebook and YouTube. If you want, join me and let's take it from there. Thank you very much. I need to go. Have a great day ahead. Take care. And if it's something that if it's a webinar that you want me to do again, please send me an email. Okay. Thank you very much. Have a great day ahead and see you again later. Bye-bye.